The global financial order encountered a defining inflection point on February 28, 2026, when coordinated military operations by the United States and Israel against Iranian strategic assets dismantled decades of relative energy stability. This initial kinetic strike served as the catalyst for an immediate and unprecedented war shock that rippled through the global energy and precious metals markets. Within hours of the commencement of hostilities, the Strait of Hormuz, the world's most critical maritime choke point for energy transit, was effectively closed to commercial traffic. This closure was not merely a tactical maneuver, but a structural severance of the global energy lifeline through which approximately 20% of the world's daily oil supply and 20% of global liquefied natural gas (LNG) trade typically flows. By mid-March, the consequences were quantifiable. Vessel traffic through the strait had plummeted by 97%, plunging the global economy into a state of acute energy scarcity. The immediate market response was a historic repricing of risk assets and commodities. Brent crude oil prices, which had been trading near $70 per barrel prior to the conflict, surged by 29% in a single day to cross the $100 mark for the first time in 2 years. Simultaneously, the precious metals complex entered a period of extreme volatility. Gold initially spiked to $5,120 per ounce before suffering a sharp reversal as institutional investors were forced to liquidate profitable positions to cover margin calls elsewhere in their portfolios. This report analyzes the multifaceted mechanisms of this shock, from the geopolitical blockade of the Persian Gulf to the systemic liquidity squeeze in the private credit markets, providing a comprehensive overview of the forces reshaping the global economy in 2026. The closure of the Strait of Hormuz represents the single largest supply disruption in the history of the global oil market. Unlike previous crises where supply was merely threatened, the March 2026 blockade is characterized by the physical inability of tankers to navigate the waterway due to Iranian mine-laying operations and the suspension of international shipping insurance. The International Energy Agency, IEA, has warned that the world is facing a deeper crisis than during the Yom Kippur War of 1973 or the 2022 invasion of Ukraine. The volume of crude and oil product flows through the strait plunged from approximately 20 million barrels per day, MBD, to a mere trickle within the first week of the conflict. As a direct result of the blockade, Gulf oil producers, including Saudi Arabia, the UAE, Kuwait, and Iraq, were forced to cut total production by at least 10 MBD as storage facilities reached maximum capacity, and export outlets remained inaccessible. While Saudi Aramco attempted to mitigate the shock by ramping up exports via the east-west pipeline to the Red Sea, this alternative route can only handle approximately 5 MMBD, leaving a massive deficit in the global market. The impact on global supply chains has been immediate, with the IEA projecting a global supply plunge of 8 MMBD for the month of March alone. Crude oil and condensates, Strait of Hormuz, 14.0 million barrels, 0.5 million barrels. Refined petroleum products, 6.0 million barrels, 0.2 million barrels. Liquefied natural gas, LNG, 20% of global trade near standstill. Liquefied petroleum gas, LPG, 29% of global trade. The secondary effects of this energy shock have permeated the global transport sector. In the United States, diesel prices rose by 25% within the first 2 weeks of the war. In Europe, the situation is even more dire, with diesel prices exceeding €2 per liter in Germany, Finland, France, Italy, and the Netherlands, and reaching as high as 2.3 per liter in Ireland. These price increases act as an immediate tax on the global economy, raising the cost of goods distribution and agricultural production. The price of fertilizers, which is heavily dependent on natural gas and Middle Eastern sulfur, has reportedly jumped by 77%, signaling a forthcoming spike in global food prices later in 2026. In an unprecedented attempt to stabilize the market, the 32 member nations of the IEA unanimously agreed on March 11, 2026, to release 400 million barrels of oil from their emergency reserves. This release, the largest in the organization's history, included a 172 million barrel contribution from the United States Strategic Petroleum Reserve, SPR. However, the market's reaction was tellingly muted. Brent crude prices barely retreated as traders recognized that the total release represents only 20 days of the volume typically passing through the Strait of Hormuz. The failure of the reserve release to quell prices highlights a fundamental shift in market psychology. In previous decades, the announcement of an IEA release was sufficient to signal a ceiling on prices. In 2026, however, the perception of transit route uncertainty has superseded the concern over lost production. Market participants are now pricing in the possibility of a prolonged blockade, with Iranian officials suggesting the strait will remain closed as long as the war continues. This has led to the emergence of a massive war premium in physical oil markets. where premiums in some regions are reportedly trading up to 40% above futures prices. Furthermore, the insurance and shipping industries have effectively paralyzed the remaining transit options. Soaring insurance premiums and the designation of the Persian Gulf as a high-risk zone have forced many vessel operators to avoid the region entirely. The shipping market, which reacts within hours to such risks, has already factored in a long-term disruption, even as politicians attempt to negotiate a resolution. This lag between the energy price shock and the eventual economic consequences, such as demand destruction and recession, is what creates the war shock environment that now defines the 2026 landscape. One of the most counterintuitive developments of March 2026 has been the sideways and occasionally downward movement of gold prices despite a major war in the Middle East. Gold is traditionally viewed as the ultimate safe haven asset, expected to surge during geopolitical turmoil. Indeed, gold initially followed the script, rising from $5,296 to $5,123 in the days following the strikes on Iran. However, by March 3rd, prices had dropped more than 6% from those highs, frustrating investors who expected a sustained rally. This phenomenon is explained by the liquidity squeeze that occurs when equity and bond markets crash simultaneously. In acute stress phases, institutional investors often sell their most liquid and profitable assets, gold, to meet margin calls on leveraged positions in other markets. This forced liquidation is a tactical necessity rather than a reflection of changed sentiment toward gold as fundamental value. Because gold is highly liquid, it serves as the global ATM during the first phase of a crisis. 1973, Yom Kippur War, plus 235%. Initial decline, 4,500%, long term. 1979, Iranian Revolution, plus 250% surge, forward 400%. 2008, financial crisis, volatile, 10% to 15% record highs. 2026, Iran tensions, plus 165%. The current gold market is characterized by a significant divergence between paper gold, futures, and ETFs, and physical gold, bars and coins. While paper traders were flushing positions in early March, physical gold premiums remained elevated as central banks and private investors in the East continued their accumulation. Central banks, particularly those in China, Poland, and the Czech Republic, have reinforced the trend of shifting reserves from sovereign bonds toward hard assets, purchasing an estimated 60 tons per month in 2026. This structural demand from central banks acts as a massive floor for the price, with major institutions like JP Morgan and Deutsche Bank maintaining year-end targets between $6,000 and $6,300 per ounce. While gold remains a monetary proxy, silver's role in 2026 is defined by a violent collision between industrial necessity and monetary demand. Silver prices had already more than doubled from 2024 levels, trading near $84 per ounce by mid-March. This price appreciation is the result of a multi-year structural deficit, where global silver supply physically cannot keep up with the accelerating demand from the green energy and high technology sectors. The March 2026 oil shock has exacerbated the supply-side crisis for silver in two ways. First, energy is a primary cost factor for silver mining. With Brent crude above $100, the all-in sustaining cost, AISC, for primary silver producers has surged, leading major miners like Fresnillo plc to cut their 2026 production guidance by 9%. Approximately 70–80% of silver is produced as a byproduct of base metal mining, and every dollar increase in energy costs pressures the margins of these operations, potentially leading to production curtailments. Second, the 15.7-year lead time required to develop a new silver deposit means that the mining industry cannot respond to these higher prices with immediate new supply. Any production resulting from today's price signals will not reach the market until the 2040s. AI data centers and 5G industrial $700 billion silver appetite solar energy, PV, industrial steepening demand curve. India mutual fund allocation. Institutional 34 to 170 million ounces. Mining supply guideline cuts. Supply 4 to 5 million ounces. Fresnillo. The most significant incoming force for silver in 2026 is the activation of the Indian Institutional Allocation Channel. Effective April 1st, 2026, India's Securities and Exchange Board, SEBI, permitted mutual funds to allocate up to 35% of their assets to silver. Given India's $181 trillion, $970 billion asset base, even a 1% adoption by these funds represents 34 million ounces of new demand, roughly half of the projected 2026 structural deficit. At 5% adoption, the demand would represent 20% of total global mine supply. This institutional locking of physical silver, combined with a COMEX delivery crisis where 59% of registered inventory was demanded in a single month, suggests that silver is entering a period of aggressive price discovery. As the oil and war shock destabilizes the broader economy, cracks have emerged in the $1.8 trillion private credit industry. On March 6, 2026, BlackRock, the world's largest asset manager, announced it would cap withdrawals from its $26 billion HPS corporate lending fund, Shilind. The fund received redemption requests for approximately 9.3% of its net asset value, but restricted payouts to its foundational limit of 5%, paying out $620 million instead of the requested $1.2 billion. This move was followed by similar restrictions from Morgan Stanley and Blue Owl, highlighting a systemic liquidity mismatch. This credit freeze is a direct consequence of the volatility triggered by the Iran conflict. Investors, fearing a prolonged economic slowdown and rising loan defaults, have rushed to liquidate their positions in semi-liquid assets. The mechanics of private credit involve long-term loans that cannot be easily sold. When a surge of investors tries to cash out simultaneously, the managers are forced to gate the funds to prevent a fire sale of the underlying loans. This liquidity crunch has a direct transmission to the precious metals markets. As investors find their capital trapped in private credit funds, they are forced to sell their liquid holdings, such as gold and silver ETFs, to meet their own cash requirements. BlackRock, Shilind, $26 billion fund. Withdrawals capped at 5%. Morgan Stanley, North Haven, $7.6 billion fund withdrawals capped at 5%. Blackstone, BCR Ed, flagship credit fund, $400 million injection to meet 7% limit, JP Morgan lending facilities. The implications for small business and microfinance are particularly severe. Community lenders, such as community development financial institutions, CDFIs, and minority depository institutions, MDIs, often rely on larger institutional partners for liquidity. When the big banks and asset managers move into defensive liquidity management mode, the flow of capital to these smaller lenders dries up. This creates a K-shaped trajectory for the 2026 economy. While large corporations may have existing lines of credit, small businesses face fewer loans, shorter maturities, and higher interest rates precisely when their operating costs are being driven higher by the oil shock. Have you ever wondered what a single event could do to the entire global economy? We often think of slow, gradual changes, but history is filled with sudden shocks that reshape our world overnight. Today, we're diving deep into a chilling scenario: the 2026 war shock and its devastating ripple effects on the global economy. This isn't just a distant possibility, it's a potential reality we need to understand. Imagine the year is 2026. A major regional conflict erupts, catching the world off guard. This isn't a localized skirmish, it's a full-blown war involving major economic and military powers. The immediate consequence? A massive spike in energy prices. Key shipping lanes are disrupted, oil and gas supplies are weaponized, and the cost of everything, from gasoline to electricity, skyrockets. This isn't just a 20% or 30% increase. We're talking about prices doubling or even tripling within weeks. This energy crisis acts as a catalyst for a phenomenon economists dread: stagflation. Stagflation is the toxic combination of stagnant economic growth and high inflation. Think about it. Businesses, facing astronomical energy bills and supply chain chaos, are forced to raise their prices. Your weekly grocery bill goes through the roof. At the same time, these same businesses, squeezed for cash and uncertain about the future, stop hiring. They might even start laying people off. So prices are rising, but your income isn't. In fact, your job might be at risk. This creates a vicious cycle. People have less money to spend, so demand for goods and services falls, further slowing the economy, leading to more job losses. Central banks are trapped. If they raise interest rates to fight inflation, they risk crashing the economy even harder. If they lower rates to stimulate growth, they risk letting inflation spiral completely out of control. It's an economic nightmare with no easy exit. The 2026 war shock doesn't just hit our wallets. It shatters the very foundation of global cooperation. The post-Cold War era of globalization, where countries were becoming more and more interconnected, comes to an abrupt end. We enter a period of intense geopolitical fragmentation. The world splits into competing economic blocs, each led by a major power. Instead of trading freely, these blocs become protectionist. They impose massive tariffs, create their own separate supply chains, and hoard critical resources like semiconductors, rare earth minerals, and medical supplies. This de-globalization on steroids has profound consequences. The efficiency we took for granted disappears. Remember being able to buy an affordable smartphone or a cheap t-shirt? Those days are over. Companies can no longer manufacture parts in the cheapest locations. Instead, they're forced to friendshore, relocating their factories to politically aligned but often more expensive countries. This fragmentation means less choice, higher prices, and slower technological progress for everyone. The internet itself might splinter, creating separate digital ecosystems with different rules and limited access. The global village we were building becomes a collection of fortified castles. Now let's zoom in from the big picture of nations and blocks to the most vulnerable individuals. The 2026 war shock triggers a silent but devastating crisis in microfinance. For decades, microfinance has been a lifeline for millions of the world's poorest people. Small loans, often just a few $100s, have empowered entrepreneurs in developing countries to start small businesses, a sewing shop, a food stall, a small farm. These tiny enterprises are the backbone of local economies. But in a world of stagflation and geopolitical chaos, this system collapses. The international aid and investment that funded many microfinance institutions dries up. Global banks, facing their own crises, pull back from what they now see as high-risk lending. At the local level, the small business owners themselves are crushed. The cost of their raw materials soars. Their customers, facing their own economic struggles, can no longer afford their products. Default rates on these small loans skyrocket, not because people are irresponsible, but because their businesses are no longer viable. The very engine of poverty reduction sputters and dies, pushing tens of millions of people back into extreme poverty. The social progress we've made over the last 30 years is undone in a matter of months. This isn't just an economic crisis, it's a humanitarian catastrophe. So what does this all mean? The 2026 war shock is a perfect storm. It combines an energy crisis with a financial crisis and a geopolitical crisis. The result is a global economy that is not only smaller, but also more divided, less efficient, and profoundly unequal. The era of predictable growth and increasing global prosperity is replaced by a new age of instability and zero-sum competition. Let's recap the chain reaction. A regional war triggers an energy price shock. This leads to global stagflation, where prices rise while economies shrink. In response, the world fractures into hostile economic blocks, destroying global supply chains and making everything more expensive. Finally, this chaos pulls the rug out from under the world's most vulnerable, causing a microfinance crisis that reverses decades of progress against poverty. This scenario is a stark warning. It shows how interconnected our world is and how a single shock in one area can cascade through the entire system with devastating speed. The stability we often take for granted is incredibly fragile. It highlights the urgent need for diplomacy, de-escalation, and building more resilient economic systems that aren't so dependent on fragile supply chains and volatile geopolitical relationships. Understanding these potential futures isn't about fear-mongering. It's about being prepared. It's about recognizing the risks on the horizon so we can have a serious conversation about how to avoid them. The path to a more prosperous and peaceful future requires us to actively work towards it, not just hope for it. It means strengthening international institutions, diversifying our energy sources, and creating social safety nets that can withstand these kinds of shocks. The 2026 war shock might be a hypothetical scenario, but the lessons it teaches are very, very real. Thanks for watching. If you found this analysis thought-provoking, please hit that like button and subscribe for more deep dives into the forces shaping our world. Let me know your thoughts in the comments below. See you next time. The war shock of 2026 is a multifaceted phenomenon that has dismantled the prevailing economic narratives of the early 2020s. The immediate explosion in oil, gold, and silver prices is the market's attempt to price in a future defined by scarcity, geopolitical fragmentation, and systemic liquidity risk. While the initial reaction in the precious metals markets was dampened by institutional deleveraging and a stronger dollar, the structural fundamentals for gold and silver have only been strengthened by the conflict. The energy blockade of the Strait of Hormuz is the most significant supply-side shock in history, and its persistence for more than a few weeks will likely trigger a global recession and a second, more powerful leg higher for precious metals as inflation becomes entrenched. The silver market, in particular, is poised for a violent breakout as the India catalyst and AI demand collide with a mining industry that is physically unable to expand production due to soaring energy costs. For professional market participants and retail investors alike, the remainder of 2026 will be defined by the management of liquidity and the search for the hard assets. The credit freeze in the private credit sector serves as a warning that the plumbing of the financial system is under extreme pressure. In this environment, the traditional relationship between risk and reward has been inverted. Paper assets and semi-liquid funds now carry unprecedented systemic risk, while gold and silver, despite their short-term volatility, remain the only assets that are built to endure when trust in the system collapses. The 2026 war shock is not a temporary disruption. It is the catalyst for a fundamental reconfiguration of global wealth. Navigating this transition requires a disciplined focus on physical possession, a nuanced understanding of market liquidity, and an awareness of the structural supply deficits that define the 2026 commodity landscape. As the world transitions toward a post-dollar fragmented monetary order, The signals from the oil and metal markets suggest that the real surge in precious metals is only just beginning.